Think of the last time the market fell hard. Not a wobble, a real one. The kind where the number in your account changes by something that feels like a year of your life. Now be honest with yourself about what you felt in that moment. Underneath the fear, there was something else, wasn't there? A small, quiet thought. Somebody knew this was coming. Somebody was on the other side of this. Somebody made money on the exact day I lost it. You were right. Someone almost always is. And in October 1929, the most famous market collapse in the history of the world, that someone had a name. He was 52 years old. He had started with nothing in a brokerage house in Boston, writing prices on a chalkboard for $5 a week. He had already been bankrupt twice, and in the week the American stock market lost a quarter of its value, while thousands of people were being wiped out on the same tape he was reading, he was reported to have made around $100 million. $100 million. In 1929 money, newspapers of the day printed the figure. No one has ever been able to independently verify it. And I am going to be straight with you about that every time it comes up in this episode, because half of what gets said about this man is legend. But here is the thing that should stop you. 11 years later, he was broke. Really broke. Court documented, filed in federal court, broke. And in 1940, alone in a hotel in New York, Jesse Livermore took his own life. So this is not a story about a man who beat the market. It is a story about a man who beat the market repeatedly and could not survive doing it. Over the next half hour, I want to show you 3 things. What he actually did, the real mechanics, not the myth. Why being right made him money and being right again destroyed him. And the one lesson from his life that is genuinely useful to you, which is almost never the lesson people take from it. Let us start in a room where nobody was allowed to trade at all. 1891, Boston. A 14-year-old boy walks into the offices of Payne Weber and takes a job that barely qualifies as a job. He stands on a raised platform in front of a board. Beside him, a telegraph ticker taps out prices from New York, and his task is simply this: hear the number, write the number, quickly, in chalk, before the next one arrives. That is it. That is the whole job. $5 a week. His name is Jesse Lauriston Livermore. He was born in 1877 in Shrewsbury, Massachusetts, on a farm to a family who assumed he would stay on it. He did not want the farm. His mother, by every account, gave him the money to leave. And in that room, doing the dullest work in the building, something happens that shapes the rest of his life. He starts to notice that the numbers have habits. Understand what he is looking at. He has no company reports. No idea what any of these businesses actually do. No news except what walks past him. All he has is a stream of prices, and prices hour after hour, day after day, all day. And he finds that when a price has been moving in a certain way for a while, it tends to keep moving that way. That there are moments when the tape goes quiet and moments when it goes strange, and that the strange moments come before the big moves, not after. Let me describe the machine, because you have almost certainly never seen one work, and it explains everything about how he thought. A stock ticker is a small brass instrument under a glass dome. A telegraph wire runs into it from an exchange. Inside, a paper ribbon about 2 centimeters wide unwinds continuously, and as it moves, the machine prints on it an abbreviation for the stock, then the number of shares, then the price. It makes a sound while it does this, a fast, irregular tapping, and that sound is why every trading floor of that era is described in the same way. People did not say the market was busy. They said the ticker was running hot. So the entire market, every hope, every forced sale, every man quietly ruining himself in another city arrives in that room as a strip of paper and a noise. Most people in the room read that strip for one thing: what is the price of the stock I own? Livermore read it for something else entirely. He read it for behavior. How fast the prints were coming, whether the sizes were getting bigger or smaller, whether a stock that had been trading in tens of thousands of shares had suddenly gone quiet, and whether the quiet came before something. That is what the phrase reading the tape meant. Not prediction, not analysis of a business. Pattern recognition on a data feed, done in a human head, decades before anyone had a word for that. He starts writing the numbers down in a small notebook. Not to trade, just to check whether the patterns he thinks he sees are actually there. That notebook is the beginning of everything he ever became. Now, I want to slow down here because this is the part of the Livermore story that actually transfers to you, and it is the part that usually gets skipped in favor of the crashes. He did not begin with a theory. He began with a record. He was not reading a book about markets. He was watching one, writing down what it did, and then checking himself. And when a friend asked him to put a few dollars into a trade, he did not guess. He went to his notebook. He was 15. The trade made him a little over $3. More than half a week's wages. Within a year, he was making more from the notebook than from the job. He quit the job. To understand what he did next, you have to understand a peculiar institution that has almost vanished from memory, the bucket shop. A bucket shop looked like a brokerage. There was a board, a ticker, a crowd of men watching prices. You could walk in with a few dollars and take a position. But nothing you did there ever reached a stock exchange. Your order was not sent anywhere. The house simply took the other side of it and kept the money in a bucket, hence the name. If you were wrong, they kept your stake. If you were right, they paid you out of their own pocket, which means a bucket shop is not a brokerage at all. It is a bookmaker. And a bookmaker has exactly one enemy, a customer who wins consistently. Livermore was that customer. He was small, he was young, and he was working from a notebook nobody else was keeping. He won, and he kept winning. In a business built on the assumption that the crowd loses, a boy who did not lose was an existential problem. So they threw him out. First one shop, then another. He started using different names. He wore a hat, he changed his clothes, he sent friends in to place orders for him. The shops circulated his description. By around 1900, at 23 years old, he had been barred from essentially every bucket shop in Boston, and he was carrying, by his own account, a few $1,000s, which for a farm boy of that era was a substantial sum. They gave him the nickname that followed him for the rest of his life, the Boy Plunger. So he went to New York to trade in the real market on the real exchange, and he lost almost all of it. This matters. Because the bucket shop had been lying to him about something crucial, and it took him years and several fortunes to work out what. In a bucket shop, the price you saw was the price you got. Instantly. There was no delay, no order book, no market moving against you while your instruction traveled down a wire. On a real exchange, none of that is true. The tape you are reading is already the past. By the time your order arrives, the price has moved. Everything he had learned about reading the ticker was correct, and everything he had learned about acting on it was worthless. He went broke, borrowed, went back to bucket shops in other cities to rebuild a stake, came back to New York, went broke again. He was, in his own words, learning the difference between being right and making money. 1906. Livermore is 29. He is short Union Pacific, a railroad. He would later say he could not fully explain why. The tape simply felt wrong to him, and he had learned to act on that feeling. On the 18th of April, at a little after 5 in the morning, San Francisco is destroyed by an earthquake and the fire that follows it. Union Pacific runs into that disaster zone. By his own account, he cleared around $250,000. And here is why I trust this story and why you should be careful with it. Because he himself insisted he had no idea an earthquake was coming. He said it plainly. He was not clever. He was positioned and the world moved his way. He got lucky. Anyone who tells you Livermore called the San Francisco earthquake is selling you something. But the next one he really did see. 1907. And I want to tell you what actually caused this one because it is one of the strangest chains of cause and effect in financial history and almost nobody knows it. It starts with copper. There is a man named F. Augustus Heinze who has made a fortune in Montana copper mining and arrived in New York wanting to be a financier. He and his brother own a large block of a company called United Copper. And in October of 1907, they attempt something that was, at the time, a recognized, if aggressive maneuver, a corner. The idea of a corner is this. Other traders are short your stock. They have sold shares they do not own, borrowed, expecting to buy them back cheaper. If you quietly buy up nearly every available share, then those short sellers have to come to you to close their positions, and you can name your price. It works beautifully in theory. In practice, you have to be certain about how many shares exist outside your control. The Hineses were not certain. They pushed the price up hard over 2 days and then discovered that there were far more shares available than they had believed. The corner failed. The price collapsed. Now watch what happens next, because this is the part that matters. The brokerage that had financed the attempt fails. That brokerage is connected to a bank. That bank is connected to Augustus Heinze, who is president of a different bank entirely. Depositors at that bank, reading the newspapers, decide they would rather have their money in their hands. They queue. Word spreads. And the queue jumps from a bank connected to Heinze to a trust company connected to a man connected to Heinze, the Knickerbocker Trust, one of the largest financial institutions in New York. On the 22nd of October, the Knickerbocker pays out until it cannot pay anymore and closes its doors. And at that moment, the panic stops being about copper. It becomes about whether any institution in America can be trusted to give you your money back, which is the only question that has ever mattered in banking. Credit freezes, call money. The overnight borrowing that lets people hold stock on margin goes from single digits to over 100% annualized. Anyone holding stock with borrowed money is forced to sell at any price into a market with no buyers. There is no Federal Reserve. It does not exist yet. There is no central bank to stop this. There is only a private rescue organized out of the library of one man's house on Madison Avenue. J.P. Morgan, 70 years old, locking bankers in a room until they agree to put up money. And through that entire month, Jesse Livermore is short, heavily. On the 24th of October, the market breaks. He made $1 million that day. Some accounts say 3 times that. The sources genuinely disagree, and I am not going to pretend otherwise. What is not in dispute is that a 30-year-old speculator had one of the great days in the history of the market on the day the American banking system nearly failed. And then something happened that he told for the rest of his life, and that every biography repeats. Word reached him from J.P. Morgan. The message was, in effect, stop. Stop selling. The market cannot take any more of it. Now, this rests on Livermore's own telling. There is no signed document, but he covered his shorts. He stopped. And then he did the thing that separates a speculator from a gambler. He turned around and bought. He had spent a month betting the market would fall. He now believed it had fallen far enough, and so he took the other side of his own conviction, in size, at the bottom, into the wreckage. That is the trade of a lifetime, not the short, the turn. He was 30 years old and worth, by contemporary reports, around $3 million. If the story stopped there, we would remember him as a genius and nothing else. It does not stop there. Because Livermore's method, the thing that actually made him money, was narrow and unglamorous, and he knew it. Wait. Do nothing. Wait longer. Trade only when the tape confirms what you already suspected. Cut a loss immediately and without argument. And never, never take a position because a person you respect told you to. He wrote that last one down. He broke it anyway. Around 1908, he meets a man named Percy Thomas. Thomas is famous, charming, and utterly certain about cotton. He is known as the Cotton King. And he talks. Livermore has no view on cotton. He has no notebook on cotton. What he has is a very persuasive man in the room with him. He takes the position, it goes against him. And instead of doing the one thing his entire method demanded, cutting the loss, he does what every human being does when they are wrong for someone else's reasons. He adds to it. He kept adding. He was wiped out. By 1915, he was formally bankrupt, hundreds of thousands of dollars in debt, and this is the detail that tells you who he was. Several brokerages still extended him credit because they had seen what he could do with a stake. He rebuilt. Of course he did. He was Jesse Livermore. And the rebuild is worth a minute because it tells you something about the man that the crash stories never do. He was bankrupt, publicly, in a business that runs on whether people will lend to you, and brokerages lent to him anyway. One firm gave him a trading line on nothing but reputation. No collateral, no deposit, just the knowledge that if you give this man a stake, he will probably turn it into something. He took a small line. He did not swing it. He traded it carefully for months in a market disrupted by a world war, waiting for exactly the kind of setup his notebook described. And when the war economy pushed certain industrial and steel names into the sort of sustained move he had been waiting 15 years to recognize, he was already positioned. He paid back every creditor, including debts that had been legally discharged in the bankruptcy and that he had no obligation to pay at all. Then he did it again the other way. He bought a house on Long Island, a yacht, a private railway car, an office with its own ticker, and a man employed to keep the board. Both of those things are the same man. That is the thing to hold on to. The discipline and the excess were not two phases of his life. They ran simultaneously the whole way through, and which one was winning at any given moment is essentially the story of his net worth. And in 1923, a journalist named Edwin Lefevre published a book, Reminiscences of a Stock Operator. The narrator is called Larry Livingston. Everyone knew exactly who Larry Livingston was. That book is still in print. More than a century later, it is still on the desk of people who have never heard the name Jesse Livermore. His method outlived his fortune by 100 years. Hold that thought, because the fortune had 6 more years to run. 1929. You have to picture the mood, because the mood is the whole story. America has spent a decade convincing itself that the market is not a market anymore, that it is simply a machine that turns time into money. A shoeshine boy has a tip. Everybody's brother-in-law is up 40%. And underneath the mood, there is a mechanism, and I need you to understand the mechanism, or the crash will just look like weather to you. That mechanism is margin. Buying on margin means buying stock with borrowed money, using the stock itself as the collateral for the loan. In the 1920s, you could commonly do this by putting up something like 10% of the purchase price. 10%. You bring $1, the broker lends you $9, and you own $10 of stock. While the market rises, that arrangement feels like genius. A 10% gain on the stock does not make you 10% richer. It doubles your money. But run it the other way, slowly, and feel where it goes. The stock falls 10%. Your dollar is gone. Every cent of loss lands on you first, because the lender is protected before you are. That is the entire point of collateral. And so the broker calls you and asks for more money to restore the cushion. That is a margin call. If you have the money, you post it. If you do not, the broker sells your stock, not to punish you, but to protect the loan. And your position is closed at whatever the market will pay at that moment. Now multiply that by a country. When enough people are levered 10 to 1, a fall of 10% does not produce sellers who want to sell. It produces sellers who must sell all at once, regardless of price, regardless of whether they think the stock is cheap. Their selling pushes prices lower, which triggers the next tier of margin calls, which produces more forced selling. That is why crashes have the shape they have. It is not that everyone loses their nerve on the same morning. It is that the leverage in the system converts a decline into a machine that manufactures its own sellers. Livermore understood this better than almost anyone alive, because he had been on the receiving end of it twice. And through the spring and summer of that year, Livermore, 52, twice bankrupt, 2 decades past the panic of 1907, starts to see the same thing on the tape that he saw in 1906 and 1907. Not a crash. Something quieter than that, and to him more frightening. He sees the market rising while fewer and fewer stocks participate in the rise. He sees leaders stall. He sees advances that are not confirmed by the volume underneath them. He starts selling, and he is early. This is the part the legend skips. Being early is not a footnote. Being early is what kills people. The market kept climbing. His positions went against him. Anyone watching him that summer would have said the old man had lost his edge. He held. He added carefully in stages, and he waited. I want to sit inside that for a moment because it is the least discussed and most useful thing in this entire episode. Imagine holding a position that is losing money every week for months in front of an entire country that is making money. Every newspaper disagrees with you. Every dinner conversation disagrees with you. Your own account statement disagrees with you. And the account statement is the one that hurts because it is not an opinion. It is a fact arriving monthly saying, you are wrong. Most people cannot do that, not because they lack discipline, because being wrong in public for a long time is one of the most genuinely unpleasant experiences a human being can have, and the fastest way to make it stop is to close the position and agree with everyone. That is why the crowd is usually the crowd. Not stupidity, relief. What let Livermore hold was not courage. It was the notebook. He had a written record of what this pattern had done before and a set of rules for what would prove him wrong, and neither of those things cared how he felt in August. Then October. On the 24th, Black Thursday, the tape simply cannot keep up. It is running hours behind. Nobody in the building knows what they own or what it is worth. A group of bankers pools money to buy the market and steady it, exactly as Morgan had done 22 years before. It works for a weekend. On Monday the 28th, the market falls nearly 13%. On Tuesday the 29th, it falls again on volume that will not be matched for decades. The bankers' pool is gone. The margin calls arrive, and every one of them forces another sale, which forces another margin call. That is the mechanism of a crash, not panic. Arithmetic. And Jesse Livermore is short the entire way down. The figure reported at the time and repeated ever since is around $100 million. I want to be honest with you a second time, no one has ever verified that number. There is no audited account. It comes from newspapers and from later biographies, and the man himself had every reason to enjoy the legend. What is not in doubt is that he ended 1929 as one of the richest men in America, in the year America got poor. The newspapers found him. They called him the man who sold America short. He got letters, threats, some of them, from people who had lost everything and had read that he had made everything. He hired a bodyguard. He had been right 3 times in 23 years, at the 3 moments in that era when being right paid the most. 5 years later, he had nothing. Here is where I have to tell you the part of this story that almost never gets told properly, because it is not exciting. It is just sad, and it is the most instructive part of the entire episode. Nobody knows exactly how the 1929 fortune went. There was no single catastrophic trade, no famous blow-up. There is a court record, and there are 5 years, and in between, there is a man who could not stop. We know he traded through the early 30s, and you should understand what that market was actually like, because it is the exact opposite of the one he was built for. His entire method needed movement. It needed a market that committed to a direction and then kept going, so that a position taken early could be added to and held. That is what 1897 gave him, and 1907 and 1929. The early 30s gave him the opposite. A market that fell and rallied hard enough to convince you it had bottomed and then fell further. Again. And again. There were violent advances inside that decline that would have taken out any short position held with conviction, and there were collapses that punished anyone who believed the recovery. It was a market with no trend to trade and enormous volatility to be destroyed by the worst possible combination for a man whose edge was riding a direction. There is also a rule of his own that he could not follow anymore, and it is the saddest mechanical detail in the story. His method required doing nothing for long stretches. But by the 30s, he was a name. He was the man who sold America short. There were people around him, obligations around him, a reputation that had to be continuously re-earned. Doing nothing is very difficult when doing nothing is indistinguishable from being finished. It was also a market that punished exactly the aggressive, position-taking style that had made him rich. We know he was carrying enormous personal costs. We know his personal life in those years was very hard, in ways I am not going to detail because they involve a family and not a market. And on the 5th of March 1934, Jesse Livermore filed a bankruptcy petition in federal court in New York. The numbers in that filing are the most reliable numbers in this entire episode because unlike the $100 million they were sworn to, liabilities, $2,259,212.48. Assets, $184,000. It was his second formal bankruptcy. By the count of the press at the time, his 4th failure. Read those 2 numbers next to each other one more time. 5 years earlier, he had reportedly made 50 times his total liabilities in a single week. He was banned from the New York Stock Exchange floor. His name, which had been a kind of weather system, stopped moving markets. And there is an irony in the timing of that filing that I do not think he could have missed. 1934 is the year the United States created the Securities and Exchange Commission. The country had spent 4 years asking how 1929 had been allowed to happen, and the answer it arrived at was because the market had almost no rules. So it wrote them: disclosure requirements for companies, registration of exchanges, limits on how much stock you could buy with borrowed money, prohibitions on the pools, the corners, the coordinated manipulation that had been ordinary practice in the world. Livermore grew up in. In the same year, in the same city, the most famous operator of that vanishing world walked into a federal courthouse and declared that he had nothing left. He was not a victim of those rules. Most of them came too late to touch him. But the market they created was not his market. The edge he had spent 40 years sharpening was an edge against a market where information moved slowly and unevenly, and a man with a good notebook could see the shape of things before the crowd did. Every reform of the 30s was, in effect, an attack on precisely that gap. He had made his life out of the difference between what the tape showed and what everybody knew, and the country decided, reasonably, that the difference should be smaller. In 1940, he published a book, How to Trade in Stocks, setting out his rules formally in his own name for the first time. It sold poorly. The public had, understandably, lost its appetite for stock market wisdom. Later that same year, on the 28th of November, at the Sherry Netherland Hotel in New York, Jesse Livermore ended his own life. He was 63. He left a note. It was addressed to his wife. What it said, in substance, was that his life had been a failure. I am not going to editorialize over that. I am going to leave it exactly where he left it and tell you that the historical record is clear that he had lived for years with what we would now recognize and name as depression, and that in 1940 there was almost nothing anyone could do about that. So what do you do with a life like that? The wrong lesson, the one you will see quoted 100 times online this week, is be like Jesse. Have the courage to be short when everyone is long. Bet big when you know. That lesson would have killed him, and it did. Here is what I think the honest lesson is, and it is quieter. He made his money on patience and lost it on participation. Every single one of the great trades came after a long period of doing nothing while he waited for the tape to confirm what he suspected. Every disaster came from being in the market when he had no reason to be, because someone persuasive told him to, because he was bored, because he had to be Jesse Livermore that day. The record beat the instinct. He was 15 years old, writing prices in a notebook and checking himself against them. That habit is the whole edge. The mystique came later and was mostly other people's work. The method outlived the man, and that is not a compliment to the method. Reminiscences of a stock operator has been continuously in print since 1923. It is handed to new traders on their first week in firms that did not exist when Livermore died, in countries he never visited. And every one of those readers knows how the story ends and reads it anyway and quietly assumes that they will be the one who takes the discipline without the disease. That assumption is the most expensive thing in this episode. It is not a fact about markets, it is a fact about people, and it is the same fact that made the crowd buy in 1929. And being right is not a plan. He was right in 1907 and right in 1929, and neither rightness protected him, because he never built anything that could survive him being wrong. There was no structure, there was no institution, there was one man, one tape, one nervous system, and a nervous system is not a strategy. Which brings us to next week. Because roughly 15 years after the crash that made Livermore famous, a man who had also been destroyed in 1929 sat down and did the exact opposite thing with the experience. He did not build a method around reading the tape, he built one around ignoring it completely, around buying a business for less than it was demonstrably worth, and letting arithmetic do what instinct could not. His students would go on to run the largest fortunes in the world. Next episode, Benjamin Graham, the man who made investing boring on purpose and why boring won. I am glad you stayed to the end of this one. If you want the rest of this series, the channel is where it lives.